Welcome to this 26th session of TAI Institute on exit strategies and how to plan and navigate for you to exit with maximum value. We have a wonderful panel of speakers here. We have Sachin, Mahajan, Managing Director, Merger and Acquisition from Canaccord Genuity. We have Derek Sito from redflags.deals.car. And we have Samir Murji, who is a lawyer from our host out here. We will kick off the session with Sachin Mahajan. Sachin is a board member at the TAI Toronto. As I said, he's the Managing Director of Mergers and Acquisitions with Canaccord Genuity. Sachin has advised on cross-border transactions, hostile public takeover transactions, private acquisitions, going private transactions, and restructuring transactions. Prior to joining Genuity Capital Markets, Sachin worked for BMO Nesbitt Burns as a member of their Mergers and Acquisition Group. He has obtained his Chartered Accountant designation from the Institute of Chartered Accountants of India and received a Master's Business Administration from Richard Ivey School of Business, University of Western Ontario. Please help me welcome Sachin to take us further.
Thank you, Lalit. Thanks, everyone. Great to be here, and thanks for making time to come on a freezing April evening. So just I'll give you a quick background, of my. So I landed in Canada about 13 years ago in '99. I had a CA and a BCom and a law degree from India, and then I came here, did my MBA at Ivey Business School, gave a bunch of interviews, joined investment banking in 2001 in BMO. Then in 2005 we opened doors to Genuity Capital Markets, which was actually my startup. I was one of the people right from inception, got invited into Genuity Capital Markets. We sold Genuity Capital Markets in 2010 to a company called Canaccord for $300 and some odd million. And today Canaccord is about $1 billion plus minus market cap. It's listed on the Toronto Stock Exchange and on the LSE. And it was sort of those few years we were a startup, and I've kind of gone through that whole evolution. It's kind of funny being an investment banker. We actually lived through the trials and tribulations of what a startup goes through. So can I get a sort of a general idea of the group here as to how many of you are sort of into the have got sort of a later stage startup versus a startup, are thinking about it? So like a show of hands, who's actually got a company which they're launching right now? Okay. And who is actually just thinking about it? It's the rest of the people are the ones who are thinking about it? Okay, and then so a bunch of people didn't raise any hands, so give me a slight idea about why you guys are here so that I can then accordingly tailor make the presentation. Anybody?
Free dinner?
Free dinner? That used to be great at MBA school. That's what I used to do. Go ahead.
I have some questions about like listed companies sold as well as private companies sold of the same type. So
I'll come there. I just want to understand so that I get an idea of why you're here.
Yeah, I help strategize for new ventures.
Okay.
With their capitalization strategies, and so I'd like to get to know more about how to get to the exit point.
Fantastic. Anybody else? Okay, excellent. So that's great. So the first question that any entrepreneur comes across, and we've got one sitting right here, and he'll probably share his views on all of these after I'm done. But one of the first questions is when to exit any venture. And to me, it's always a catalyst. There's always a reason why you decide that you need an event which will, which basically instigates an entrepreneur's mind. Sometimes it's just absolutely being claimed bored of managing. Entrepreneurs, by definition, want to grow, and innovate, but they typically don't like to manage. And that's why you've seen Yahoo and all these other companies, and after a long time, Bill Gates kind of stepping aside and doing other things. It's just that it's not in their nature to start looking at this, looking at any kind of a venture which becomes mundane for them. That's not how they're built. So so my first point is there when it's right time to go on to do the next thing. So that's why they want to exit. The second one is when they need more money, and that money could be to grow. The money could be, financial circumstances. I want to take something off the table. I've been working since I was 15 years old. I've been putting in 20 hours a day, and I want to do something new this time. So I want to take some money off the table and bring in some fresh talent. Some of the smart ones also understand that, look, the market is ripe. I want to exit now. And that's what the private equity guys and the venture capitalist guys do for a living. That's why they're generally better at this than average people. The biggest reason for that is they know when is the right time to sell your business and make the biggest bang for the buck. And that's why that's why they actually have these supernormal returns, and why entrepreneurs generally can't really time the market, because that's not what they do for a living. But the private equity and the venture capital guys know how to do that. Anticipation of a downturn. This is also more of a financial markets thing, but if you are setting up a business and you are living through it day in and day out, you can almost smell it that in 12 months, 6 months, 18 months, there's going to be lower orders coming in, or if it's an IT services company, people are not going to come back to me. My repeat customers seem to be cutting their budgets and stuff. So it's a kind of a smell test, and people decide, look, it's time to, it's probably the right time for me to exit, and I'll make the best bang for the buck now, and let somebody else guide through with this business. So those are sort of the more astute people who probably, in more recent memory, everybody who sold in 2007 and versus people who sold in 2008, 9, and 10. So those would be that category of people. So the last one is the one that kind of I started with, is that I've got a business model, I develop it, but it's not a one-man show anymore. I don't know if you guys have actually read about the lady who set up Body Shop, but if you guys can ever look at, there was a Harvard Business case study done on the woman who set up Body Shop, and that's a best case in point about how somebody sets up one shop, two shops, and suddenly it started getting too big for her, and then she had to bring in her case, forcibly, there was a new management change. She still is the heart and soul of Body Shop, but they've actually got professional managers now running it, and that's why it's become the the store in every mall that you've probably gone to today. Now the question, and that's kind of to one of the questions that was asked, and I'll try and answer that question specifically, but is which exit strategy to choose. And we look at this, and this is actually a true investment banking chart. So the stuff that we do is pitching to companies which have hundreds and millions of revenues and billion-dollar market caps and stuff. But the funny thing is, this is the exact slide that we show to them. So you can see that whether you are a startup which does $15,000 or $20,000 a month or a year, or a $15 billion company, the issues are exactly the same, and it's the same slide. So this is actually literally a Canaccord Genuity slide that I cut and paste here. So just so that to give you an idea that it's the same conundrum for every CEO of a large company versus an entrepreneur. It's the liquidity continuum. It's you could be in this stage here where all you want is you want to be part of this business, you want to still grow, you are lacking some capital, so you go to a private equity shop or a venture capital shop and say, put some money in me, and I want to lose only 20% of my business, but I still want to be in control. I want to take this to the next level, and I want to do it. The middle one is the IPO route, and that's when, you know, either the market is great, or you've seen a bunch of businesses that you want to integrate into your business. Then you go to somebody like a Canaccord and say, look, guys, take me public. I'm doing certain EBITDA, certain amount of earnings and cash flow. But in order to be in the middle stage, typically you're looking at least cash flow of about $3 to $4 million minimum for very small size listings. And those would be actually on the TSX Venture Exchange listings. You can't really IPO in Canada unless you have about $15 to $20 million in EBITDA today. And people actually have started looking at earnings back again. But in year 2000, if you had even $15, $20 million in revenue or no revenue, you could IPO. But those days are long gone. So this is a true IPO. It's a growth alternative. You still will be some part of this business going forward, but there will be too many people sitting on your head now. So you have to be clear between a private placement, where you get somebody to take a small stake in your company, versus an IPO, where you now have a board, you answer to a board, you've got public shareholders, the level of governance changes, and things change very dramatically. And the last one, which is more relevant to the startup side, is a complete sale of the business. This is when you basically are done with your venture. You spent the time that you have, and you essentially go on for a sale. Even in this last case, your liquidity will be complete, as Derek will take you through it. You will be out of the business. You will have no more headaches, and you'll be spending a lot of time at home. But in that alternative, you don't have a continuum. You don't actually are part of business. You may be kept on as a part of business because you are the heart and soul of the business for a short period of time, 12 to 24 months in most cases. But you generally have, you know, basically said, I'm done with this. Thank you very much. From my perspective, you know, if you have decided that this is the right time for you to start exiting your business, it shouldn't be an afterthought. I think every time you're going in, setting up a business, you should always think about exiting the business. It is key. You know, it's always, whenever people come to me and say, Sachin, hey, you know, I've set up my business, I'm doing well in the business, I want to sell now. And when I ask him some fundamental questions, they've not thought about them yet. It's too late at that time, or you can take about 6 months to set yourself up to sell your business. I always say from day one, it's like anything else. You should always be in a position to sell your business the day after tomorrow. And you know, in order to do that, you have a few things that you have to keep in mind. One is you have to have a business plan ready. So generally, any business that you're starting, any startup, you create a business plan. It should generally be updated. You should know what's in it. You should know when somebody sees it, people should be able to interpret it. I've seen business plans, and a business plan is a loose term. Business plan could be even an Excel model of, this is my revenue, this is my, these are my costs, and this is my profit. Even that simple model that you built on your business, it should be something that's legible for somebody else to read. So I can actually look at it and say, oh yeah, I can actually see that you're making, you know, $35 a day. And I've seen a lot of times that people actually show me stuff. They've put something on a piece of paper, but I have no idea what those numbers mean. So you should generally be ready to, you know, you should be versatile and be prepared to actually, you know, prepare a business plan. The second is aligning the key business personnel. I would say about 50% of the time when we deal with M&A, and this is, forget about startups, this is about large companies, is that within the management team, there's lack of alignment, which means the CFO doesn't want to sell or doesn't think it's the right thing to do. The CEO thinks it's the right thing to do. 3 of the board members will think it's the right thing to do, and 3 of the board members think it's the worst idea ever. So that is the alignment that what the second point is about, is that you need to make sure that generally the key decision makers in your business, whether it's you and your partner, whether it's friends and family, are all on the same page that it's right time to exit, and otherwise it'll be disruptive to your business, and it always happens. Clean-up structure is key, and this is the point that I was talking about, is from day one, when you set up your business, you should always set it up in a way that it's ready to be sold. And what that means is make sure that when you've taken money from your friend X and that money has come in, it is actually coming in through some, even if it's cash, it's coming in some form of a receipt that you can give to somebody else and have a general ledger entry in there, because people want to see how much money has come in, how much revenue you are making, and people just completely forget. A friend of mine, and a practical example, he runs a big event, has about 80,000 people that attend that event. And a few months ago, he came to me and said, Sachin, I really want to sell my business. And we're talking about a valuation about $30 million here. So I looked at him and I said, great, you want to sell your business? Let me see your books. He said, yeah, but there's a little bit of a problem. So I make about, $6 million in cash, and of which about $3 million is actually in the books, and the other $3 million I get in cash, and I just pay the people off. And I said, okay, so then do you have the receipts and stuff? And he said, no. So what happened is the accountants went in. He's got a value of $3 million because the accountants never could see the cash that came in, which was quite significant, of about $3 to $4 million, which he would just use to pay the expenses, but he never kept any receipts for it. And he's been doing that for 17 years. Okay, so what happened when the company actually looked at his books, and this is a large multi-billion-dollar company looking to buy this little guy, and they said, well, here's your multiple of 6 times, but it's 6 times 3 million versus 6 times 6 million. So that was last year. This was a few months ago. Now he's actually doing his last show this year, and he's actually going to make sure that he can actually. So the way they've structured the deal, they said, here's $15 million. That's what we think you're worth. If you can prove to us that you actually get the revenue that you say you do, which will be in this show, then we'll pay you $30 million. So just a live example of somebody who's making millions of dollars, has a big house, big car, has everything, but had given no thought to actually cleaning up his capital structure, making sure, and the other part that he didn't think about is he's got 2 kids. You've got these capital gains exemptions and stuff that government has given you. He's not set up for any of that. Again, making too much money, not using a capable lawyer to just tell him very basic stuff, not using an accountant to put in the entries. So I strongly suggest, however small you are, from day one, make sure that all your books of accounts are properly kept. It's very basic advice. You don't need to pay anybody for it. It's just very simple stuff. Like even if you are opening up a shop, just make sure that you are bringing in money, at least in your own leisure. I don't care what you do with the cash, whether you're paying HST or not, but just somewhere you need to make sure that you've got a ledger with checks and balances. That was the next point about accounting. Then the next point about advisors. And when I say advisors, I don't mean investment bankers, I don't mean lawyers. I just mean, if people have seen Godfather, you remember the whole consigliere? You need a couple of people who've kind of been there, done that. So if you're in an industry, let's say you're a restaurateur, and you own a Boston Pizza, speak to a guy who sold his Boston Pizza recently, his franchise to somebody else. Speak to another guy who's selling his Pizza Hut franchise to somebody else. That could be your advisor. So these are very key people, and it doesn't matter how big or how small you are, you need to surround yourself with intelligent people who actually lived through a startup and have exited. And those are also called mentors. So I put the advisors as a broader term. It could include mentors as well. Intellectual property, I'll leave for Samir to tell you more about it, but it is very important. If it's a business that is software driven and you've created something which is very unique, if you are inventing something, make sure that it's properly registered and you've got the IP done. I've seen a lot of cases, and I can give you lots of examples where somebody created a phenomenal idea and it never went anywhere because he didn't register his IP in his name, and somebody else took that idea and ran with it. Just on, how are we doing on time? Okay. So in terms of the process, this is sort of getting into a realm where not many people in this room would identify with, because you're actually not, this is actually a startup, but I'll take you quickly through it. If you were ever thinking about selling your business, the key things to think about in doing that is which, people just come to ask me and say, how will I know who should buy me? And you guys investment bankers, you can pull up a whole bunch of magic and stuff. Trust us, our first source that we generally go to, yes, we have very sophisticated, for multi-billion-dollar companies, we've got sophisticated data providers that give you the data, but sometimes I'll just Google it and say, software company, Canada, yada, yada. Like, well, there's a large, multi-billion-dollar company in India. They called last week and said, hey, Sachin, we want to acquire somebody in IT services in these 3 segments in Canada. And there is no source for IT services, and they want revenue of more $50 million. So guess what I did? I went on Google, and I literally Googled 6 or 7 names, and I'm going to have literally put them down, and somebody is actually cranking through them and trying to figure out what revenues they have, how many employees they have, and stuff like that. So it's just basic stuff. If you're in the industry, you will know who can buy you, and you should identify those guys all the time. And it doesn't matter what kind of industry you're in. Yes, your advisors will always help you. They can always come up with better ideas, because sometimes thinking outside the box works, and Derek will probably tell you Yellow Media would have been the last choice that would have bought Red Flag deals.
I hope not, but
I think the answer is yes. You've got mentors. Again, TIE has a program. They give you free mentorship. Use them. There are people who have been there, done that. There are capable mentors who know, if you're a business doing a certain activity, we can find within the TIE universe people who've actually exited exactly similar businesses, and they can give you great ideas on how to position a business and who to sell it to. Phone a friend. I just had a friend of mine, I gave you an example of the guy who's got that business he's being quoted $30 million for. He does it's like a stage production company. And he literally called me and said, hey, Sachin, you're a banker, and his kid and my kid, they play together and do they have play dates together. That's how we know each other. So I literally said, hey, aren't you an investment banker? Here's my company. Can you find other companies that will acquire me? And that's literally, I did a screen for him at my work, and it took me about 30 seconds to tell some junior guy in my office, hey, can you look up the 6 companies that do this? They did. They sent it. I flipped it to him, and he did the rest. He called those guys up and said, hey, I'm up for sale. They said, yeah, we know you guys, and that's how it happened. So it's not tough. I'm sure in some part of your life, there's a lawyer, there's a banker, there's a private equity guy, even an accountant that touches you somewhere, and he will have the resources to actually dig up a few names of people if the top 3 or 4 things don't work properly. And the last one I talked about is speaking to somebody who's actually I think that is the biggest source, because that guy has gone through this whole exercise prior to you, so he can give you all the targets on that. When I say screen targets, you could have a plethora of companies that come up, and this is no magic. You can look at those companies, and you know your business. You'll be able to figure out which company is a better fit to acquire my company and which company isn't, and that's what I mean by screen targets. The pitch materials and the due diligence material, this is sort of going into a different domain, but basically you need to have, it could be a piece of paper, it could be just your speech. When you see somebody and say, why do I want to sell my business, you have to have a compelling 30 seconds, 1 minute of a predetermined speech ready for that guy. So when I say pitch materials, it could be preparing yourself, it could be preparing a 1-pager, it could be preparing 10 pages. It's whatever documents you think will propel you and will show the guy sitting across from you, this is how my business works, this is how I've taken it from 0 to wherever it is today, and I'm getting that understanding. That's what the pitch materials does. The due diligence material is the stuff that I've talked about, is all the accounting that you guys have, whether it's on a piece of paper or wherever, you'll have to start putting it in a proper format so that people can start looking at it. Remember, the guy who's going to buy you think about, you are the same guy. If you were going to be an acquirer, you will need proper documentation. You will need to know, is your company incorporated, where is it incorporated, where are the articles of incorporation, how much revenue are you making, where's the revenue coming from, where are all the receipts. So they will take that entire binder, and that binder is called due diligence material. Note on valuation, this kind of goes back to one of the questions that was raised earlier. For startup businesses, I would just focus on generally the first one, which is cash is king. So whatever cash you generate or have the propensity to generate, so if there are certain businesses which may not be generating any cash, but you may have put in several $1,000s in trying to bring it to where it is, but it has the ability to generate. If you can show the guy who's buying on the other side, this is how much cash it's going to generate eventually, that's what values your business. The rest of the stuff that I put down, the discounted cash flow and the multiples approach, I'm not going to delve into the details on that. You will find people who run the numbers, crunch the numbers for you. Multiples is nothing but saying, there are certain publicly listed companies, and this is what they trade at. From a public markets perspective, if I apply the same multiple to my company, let's say you're making $75,000 in revenue, this company trading at 3 times revenue or 2 times revenue in the market, you apply the 3 times 75,000, so you could be worth anywhere from $150,000 to $225,000. It's that simple. It's not very complicated. That's what discounted cash flow. I'll leave it for for a time when you're actually selling your business. Come to me. I can spend hours on end on all kinds of discount rates calculations and how to do it. Or you can just Google it. I'm sure just say DCF, and it'll give you all the information about a DCF. You can probably even find a program where you can just plug in your revenue and your cash flow numbers, and it'll actually spit out a discounted cash flow. The discount rate for your business, that's a very tricky one. I would just take a rule of thumb. If you're a business that does, always the best number is about 10%. That's if you're a seller. If you're a buyer, it's always about 25%. And you will probably understand that if you haven't done a DCF or a present value, you won't really understand what I'm saying. But if you have, you will know what I'm talking about. But it's essentially saying, somebody saying you're worth 10 times your cash flow versus somebody saying you're worth 4 times your cash flow. So it's that different.
Question.
Sure.
On the cash calculation, typically would you use past performance, past numbers, or future numbers, or a mix of both?
It's a great question. So definitely the future is a projection of the past. So typically how we build a cash flow forecast is by looking at the history. So in most cases where you're building only from the future forward, they tend to be wrong. So you have to look at the trajectory of growth. So typically all our modeling is done, even when you're sitting down with management, is to look at what have you actually done, show me that, because I can see the hockey stick all the time. In every single business, people actually just joke about this hockey stick term. We've seen it in every single business where managers are just optimistic about what they're going to do. That's just the nature of the beast. It's just every entrepreneur thinks I'm going to make, if I'm making $15,000 last month, I know I'm going to make $40,000 this month. It's just normal human tendency, but it never, I should say never, it generally does not end up happening. So yeah, so the historical numbers are the best predictors of your future.
For let us say publicly listed company, discounting value, can it be taken as let us say American company, yield on 10 years treasury bill?
No, it's a little bit complicated than that. It's called the CAPM model, which is used to calculate the discount rate on the equity. And just for this audience, it'll get too complicated, but that is one of the elements of the formula. But you take the risk-free rate, which is the discount rate on the bonds, and you add a risk premium to it. How do they calculate the risk premium? Just Google it. It's about 6 or 7%. Okay, so you add that risk premium to it. Now, if you're a private company, then there's something called Ibitson, which actually does a private company premium on top of that, and that will give you your cost of equity. But I can spend a lot of time. It's probably just easier. Just Google the word CAPM, C-A-P-M, and you will see the answer to that question and the calculation for it. Just in terms of maximizing value, the key themes here: the timing of exit, so knowing whether it's going to be a downturn, so I should sell now, the stuff that I had on the first page, or knowing that the market is such that everybody wants to buy the kind of business that I'm in. That's what I mean by timing of exit. The preparedness is the page that I showed you where I said, make sure that your books of accounts are done, make sure that all the legal papers are in place. Don't be sleeping at the switch. If you have cash transaction, that's fine. Just make sure they're properly accounted for, otherwise you will never get value for those cash transactions. Identifying the right team. This is two meanings to it. One is making sure that everything is aligned, that that your partners want to sell, the people who have made investments in you, your parents, they are telling you to sell, and within your company, there should be a team of 2 or 3 people that need to be working with the purchaser. We just went through Yellow Media. I don't know if you guys have read in the newspapers or not, but Yellow Media, which is the Yellow Pages business, got restructured. It had about $2.7 billion of debt. We restructured it. Now it has about $900 million of debt. But what happened is that for that 8 or 12 months, the entire management team was focused on the restructuring and not focused on running the business, because they can't be. Because every single day, I was on the phone, or somebody else from my office was on the phone, or somebody from the law firm was on the phone with them, telling them, this is what you need to do, this is what you need to do, but nothing to do with their business. So that was sort of the unfortunate part. So you have to make sure that you've got the right team of people, because selling your business is a very distracting process. You stop running the business, you only focus on selling the business. And that takes away from your business. A lot of businesses I've seen which are put off for sale actually end up getting so deteriorated that they almost shut down. And that's actually happened to a friend of mine. Telling a good story, that's the part where I was telling you to prep. That's your pitch materials, to make sure that you're ready. And that's what this program will do. I'm sure there are other people who will take you through it. Credibility, it all talks to this, I think, is important, very, very crucial. If you show somebody numbers on day one, okay, and say, oh, you know what, I made a mistake, and they do some work on it, and you had shown, certain company had actually invoiced you, but they find out that that company, that your number for the invoice was wrong or something was incorrect, you've lost the credibility. You can kiss that purchaser goodbye, because it's very important to make sure when you're selling your business that you under-promise and over-deliver. But having said that, to this room, I can promise you that in most cases we get involved in, it's the other way around. Even for companies that are very well established, and again with hundreds of millions of revenue, they make the opposite mistake all the time. Knowing your investor and acquirer, when you're in your business and you had a few conversations, generally you will end up knowing, just like when you're selling your business to your customer, you anticipate or you get a sense from your customer. Similarly, your investor or your acquirer, you have to read his mind. You have to make sure you understand who he is, what he's trying to do, how much can you push him, and the face. It's like poker, except that you're not wearing sunglasses because you look stupid. So it's fun.
Would you lend any credence to the suggestion that someone told me last week even, that American tech companies get higher valuations, and does that translate into higher exit prices, all other things being equal? Will an American company that does the exact same thing with the exact same cash flow get sold for more?
That's a bit of a loaded question, because the answer could be different in different industries.
So it's specifically high tech, web, mobile, that sort of thing.
I don't think so.
Okay.
I don't think so. Probably, but we haven't faced that, at least in Canada. We are the most prolific investment bank in IT, and we can tell you that when your company is publicly listed, we can see the same comparables as in the US. There should be no reason why the US company. It probably was true about 6, 7, 8 years ago, just after the dot-com bust and stuff, and people were trying to reinvent themselves. But I think Canadian companies, if anything, actually have very good credibility in the market. People actually want to buy Canadian. And if it's a US to US acquisition, I maybe not be that might be an anomaly. But these days, high-tech IT companies are not being bought by the US guys, they're being bought globally. And then from a global perspective, my sense is, and we have offices across US and we do a lot of IT business, is that they prefer Canadian companies today to US company counterparts. For a whole host of reasons.
Do the early stage valuations, which do seem to be statistically higher, affect the sale price? Or not? If at the end of the sale price, like you said, is mostly revenue and other.
Yeah, I mean, look, I mean, at the end of the day,
they're raising like $5 million angel rounds, and
yes. So
we don't have
because we don't have that. That's a lack of liquidity issue. It's got nothing to do with valuation, though. So if you're selling a business, let's say you've generated, you passed that and you're selling your business, and so let's say it's a $200 million US business, a $200 million Canadian business, I see no reason why both businesses get the same value. However, if you are a $300,000 Canadian business versus $300,000 US business, which is just because you won't have the same number of people looking at your business because of lack of depth in Canada, the answer will be yes.
Okay. Excellent, thank you.
Very quickly on deal dynamics, time is definitely not your friend. One of the things that we've always seen is if your purchaser is lingering about and taking a lot of time and not getting back to you, that means something is wrong, and they may not be very interested in doing the transaction. You need to be nimble, you need to be quick, and the worst thing you can do is drag your feet when you're trying to sell your business, because that will actually put off your buyer and your price. There's always a guy in the purchaser's team or the investor's team that you can get along with. He should be somebody who's a decision maker or a quasi decision maker, but try and connect with that guy, because you should always be able to pick up the phone and call this one guy who may not be the owner of the private equity fund or the CEO of the strategic buyer, but somebody you actually get along with for any reason. Maybe he follows the same football team or the hockey team that you do. So you need to find that connection. Establish trust. It also goes back to credibility. People actually think that, if I have 50 people looking at buying my business will be sold at a higher value. It's generally not correct. You should limit the number of people, and let's say there's about 8 or 10 people. You're a small startup business. You have no ability to start negotiating with 8 or 9 different people. So try and minimize that and try and speak to 1 or 2 guys who you think will give you the right advice and the right value. And the last one, you also have to think, in most cases I've found, when you actually want to exit for the highest price, you always end up finding that there are other things attached to the deal that don't work out. So make sure that the deal that you're cutting is not only based on price, but also what your employees are getting at the back end. What kind of shackles are they going to put on you? A lot of times I've found entrepreneurs who quickly say, oh, you know what, this guy is giving me so much money, but he's telling me that I can't do anything and you have to work for him for 18 months. They can make your life hell for those 18 months. So you have to be careful about what you're trying to do when you're getting the highest price, because it may not be. You can take a couple of bucks less, but have more flexibility. I think that's basically what I had to say about exiting. Any questions? Anything I can answer?
Can you walk through your process of Genuity acquired by or merged by Canaccord?
Oh, sure. So Canaccord was on the lookout for acquisitions, and Canaccord is set up as a wealth management business, and they do a lot of equity financing. So they are a powerhouse in raising equity. They do, I think, 300 to 400 equity deals and raise about $3 or $4 billion every year. But they don't have an M&A advisory business. Genuity was the foundation of Genuity Capital Markets was the M&A advisory business. So we were an independent small boutique, but we were competing with all the major investment banks in Canada and the US. So we would actually go in for transactions, and the Goldman Sachs banker would be walking out and we would be walking in. So we were a very powerful M&A franchise. So the fit was there between Canaccord, which had a lot of equity but no advisory business, and we had the M&A business, which is the mergers and acquisitions, and the advisory business. So that was the fit when we came in. The price negotiations were extensive. This is all public knowledge, but in most investment banking acquisitions, what happens is we make a payment, and the next day, half the investment bankers leave and join the next firm because they've cashed out. In our case, 80% of the transaction price was given in form of shares, 20% was given in form of cash. The 80% had a 5-year, in some cases 3-year, in some cases 5-year gestation period. So the shares actually vest a third. So that was kind of the way the deal was structured, and that's how sort of we were put together. Because in most of the services business, most of the entrepreneurs, in IT services and stuff, the core is the 2 or 3 guys basically run the business. Even in our case, they wanted to make sure that the guys who actually bring in all the business, they are shackled and they don't leave, and that's why it was structured properly.
Any more questions?
It doesn't sound to me like do-it-yourself business. So at what time you get involved, and what kind of company should call you?
So definitely not startups. We get involved, generally our deal sizes have to be about $75 to $100 million. So before that, we generally don't get involved in businesses. And but there are other investment banks and even the accounting firms that will get involved in sales which are $3, $5, $6, $7 million. And then there'll be these very small one-man boutiques that'll get involved in 100,000, 200,000. Like I recently bought a restaurant, and we actually found a guy who advises only on restaurants. That was a $250,000 restaurant that we bought, and this guy advised us. So you can find advisors anywhere, everywhere. But my team was a little bit bigger than that, so I was actually paying this guy 4% to make that acquisition for me, but I had 6 people who were running restaurants advising me on how to buy a restaurant, and those guys were people who were serial entrepreneurs in the restaurant. So
your specialty is IT, you mentioned, but I would assume it's a software more than IT.
No, we do everything. So we sold Genuity, we sold Zarlink last year. We also took all the way back, the first ever IPO that happened after the bust, Miranda. So we've done everything under the sun. In IP, we did Vylan, we did the hostile. We were advising Vylan on the hostile bid. For Mosaic last year, if you guys remember that transaction. But we've done everything in IT, so it's more broader than just software.
One last question.
Yeah, hi. So you talked about how cash is king with regards to how much cash a startup is generating. But on the flip side, when you're exiting, do you see deals? I mean, is it typical to just have all cash deals, or is it like a cash and stock sort of mix? And what would you advise startups on that?
The cash is king is actually only relevant for the cash that you're making.
Okay.
It's not relevant on the consideration that you're getting.
Okay.
So that's a completely different point of view. The problem with the consideration in a private company is that what are you buying for the other guy, from the other guy? So if the other guy is saying, take shares in my company, which is a private company, and I'll give you 50% of your consideration is cash, what does that mean? It means nothing to me. I don't know your company. I don't have time to do due diligence on your company to see how much money you are making. So when it's startup businesses, typically if it's not a public company that's buying you, the consideration doesn't matter. It has to be cash, in my view. What it can be is that I'll pay you, 80% now, and 20% I'll pay you if you if your company hits the certain milestones. That is acceptable, and it's probably a norm in a lot of businesses. And Derek can probably speak more to that. But in a lot of cases, like the cash is king is only about the money that the business is generating. It's not about what you are getting.
Right. So if you got a much higher valuation from somebody with a mix, you'd probably reject that.
But the mix of what though? Because is the mix of a public company or a private company?
No, private. I mean, public, obviously.
Yes. No, absolutely not. Absolutely. Why should we? No. The question was, in most cases for a startup, if you are getting Cisco stock, it's as good as cash. Okay. If you are getting stock for 9141763 Ontario Inc., I don't know. It's a company that trades by appointment. The guy says, "Oh, my stock's worth $3." It could actually be worth $1.50 or worth $0, because he's the guy who's actually trading the stock himself. So it all depends on that. So I wouldn't say. So you have to see the company that's buying you. You have to make sure that the shares that they're giving you are actually worth. Because typically they will say you can't sell the shares for 6 months. So you have to make sure that the stock price. So I invested in a company called Adenio. They sold to a company called Motricity. We sold for $20 a share. Motricity stock was $13 the day we sold. Today the stock's at $1.07. So, should I have taken these, all cash at that time? Probably, but we didn't. So we are where we are. So they paid us 50% cash and 50% in the stock. Okay, great.
Thank you so much, Sachin.